Hi, I'm Paul Gorrie from the Navigator Network, the reigning Australian Firm of the Year with the Now Infinity Group consisting of over 300 accountants and financial planners. The 2016 federal budget was a doozy in terms of the changes to the superannuation system. I'll go over the main changes to super and how they affect you and your self-managed super fund, and some strategies that you can use to take advantage of the new changes. The first change relates to the amount of concessional or tax-deductible contributions you can make to your super from 1 July 2017. The concessional contributions cap will reduce for everyone down to $25,000. This is a reduction from the current contributions allowed, which are $30,000 for people less than 50 years of age and $35,000 if you are 50 years of age or older. Because the $25,000 cap does not start until the 2018 year, it's important that you consider taking advantage of the current higher concessional caps that exist for the 2016 and 2017 years, and take advantage of them. The next change starting from 1 July 2017 will be the ability to carry forward unused concessional contributions for up to 5 years as long as your superannuation balance is less than $500,000. Therefore, if you will be taking a break from the workforce at some stage, you have the ability to catch up your super contributions if you have the ability financially to do so. This initiative is aimed at people who stay at home with their children for a few years and re-enter the workforce. Next, from the 3rd of May 2016, which is budget night, there will be a lifetime cap for non-concessional contributions of $500,000. This lifetime cap will take into account all the non-concessional contributions made from 1 July 2017, which is apparently the date the tax office say they have reliable contribution records available. And if you exceeded your cap from this date until budget night, you will be deemed to have not exceeded your cap, but just fully utilised your $500,000 lifetime cap. This lifetime cap replaces the current non-concessional limit of $180,000 per year for those people who are less than 65 years of age, and also the $540,000 3-year bring forward rule. Also keep in mind, people aged between 65 and 74 years of age who are currently limited to the $180,000 per year cap will have access to the $500,000 cap without having to meet a work test. To determine how much of this lifetime non-concessional cap that has been utilised with prior non-concessional contributions, you'll have to add up your non-concessional contributions since 1 July 2017. I'm sure that's really going to test some people's filing systems. Next, from 1 July 2017, the contribution eligibility requirements for those aged between 65 and 74 years of age will be removed. This will allow people who are under 75 years of age to make contributions to superannuation without the need to pass a work test. Up till now, people who were required to work 40 hours in a 30-day consecutive period in a financial year to make a contribution, and this proposal will remove that requirement and make it easier for older people to contribute to super. Next, again from 1 July 2017, there will be a $1.6 million superannuation transfer cap introduced. This transfer cap will be introduced to restrict the amount you can transfer from your superannuation or accumulation balance to your pension account. Any excess that is maintained in the accumulation balance will attract a concessional tax rate of 15%, as opposed to a 0% tax rate the cap pension balance earnings incur. This cap will be indexed in $100,000 increments in line with CPI. For those people already in pension mode and a balance in excess of $1.6 million, it will mean from 1 July 2017 you'll have to either transfer the excess back into your accumulation or withdraw the excess from your balance. Next, from 1 July 2017, the current Division 293 tax, where an additional 15% tax applies to superannuation contributions, will be reduced to income exceeding $250,000 from the current level of $300,000. The overall impact of this is a possible increase in tax of up to $3,750 if your income exceeds the $250,000. Please note the definition of income for Division 293 includes your taxable income plus reportable fringe benefits, plus net investment losses including rental property losses and superannuation contributions. Again, from 1 July 2017, the transition to retirement pension earnings tax exemption will be removed. The current tax exempt status of income from assets supporting a transition to retirement income stream will be removed, and earnings will be taxed at 15%. Taxing earnings on a TTR, on TTR income stream significantly reduces the attraction of a TTR strategy, particularly if you're less than 60 years of age. For those over 60 years of age, a TTR may still be a worthwhile strategy. Next, from 1 July 2017, the current spouse superannuation tax offset income threshold will be increased from the current level of $10,800 to $37,000 for the spouse's income. Also from 1 July 2017, the anti-detriment payments will be abolished for lump sum payments made to eligible beneficiaries when a member passes on. This will effectively mean eligible beneficiaries will no longer qualify to have a death benefit uplifted by 17.65% under the formula method. It may also mean that more beneficiaries elect to take their benefits in the form of a death benefit income stream. Also effective from 1 July 2017 will be the ability for all Australians who are less than 75 years of age to claim a tax deduction for super contributions regardless of their employment status. This means that you do not need to be an employee or satisfy the 10% employment test when deciding to make a super contribution. Please keep in mind this is a guide only, and you really need to seek professional advice when making a decision about your super. If you'd like more information about anything I've said here today, call our office on 0755 970 661 or email us at cpa@navigatornetwork.com.au. This is Paul Gorrie from the Navigator Network signing off.